Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So as the S&P 500 tests its bear market downtrend line that we've had since January of 2022, now testing this trend line for the fourth time, we're seeing something very interesting here amongst fund managers. This is a survey from the Bank of America Global Fund Manager Survey, and it highlights that fund managers right now are turning less bearish on growth. And you can see here, this is the net percentage of fund managers expecting a stronger economy. It collapsed towards the end of 2021 and into 2022. It stayed flat so far. Now it's turning back up, explaining some of the gains that we've had over the past few months. And that is particularly strange because if we look at this chart right here of the 2-year minus the 3-month yield curve, it's inverted to the deepest level we've seen since 2000. That means that the bond market currently is expecting that the Fed needs to cut rates somewhere in the next year or so. The fact that the 2-year yield is lower than the 3-month yield is very rare. It only happens around recessions when the economy is weakening because the bond market only expects the Fed to cut rates when the economy is weakening. So we're going to be dissecting these developments in detail in this video, and I'm going to show you why these fund managers that are turning optimistic on growth are most likely wrong and how this is going to play out in the market today. By the way, if you are new here, don't forget to click on that subscribe button and smash that like button if you enjoy this episode. Now, without further ado, let's get right into it. So here's another chart that shows you the risk appetite that's going up over the past couple of months here. While risk appetite throughout 2022 was incredibly low, right? Ever since around June of 2022, we hit some very extreme readings, showing a lot of fear in the market. And since then, we've had a recovery in the risk behavior of market participants. So people here are getting excited about the market. They're getting excited about the economy, just like they did in these instances right here. In a lot of these cases, like March 2020 and January 2019, that was a great moment to be buying stocks. March 2020, January 2019. Now, of course, that level was revisited during the March crash because of COVID, but in the near term, the market rallied significantly off that level of the January 2019. So you could argue that we are in a similar spot here as risk is recovering from a very low level in June and October. A lot of people got very pessimistic, and we're in the beginning stages of that recovery that could very well happen if we start to break above this downtrend line. But let me show you a couple of other examples here. August of 2006, July of 2008, and December of 2000. Now, of course, we all know what July 2000, that was, of course, a very bad moment for fund managers to start getting optimistic about the economy right before earnings started to really collapse, right? So yes, the Fed was easing back here. They had brought down the interest rate very, very significantly, and investors were starting to price in the fact that that easy money would start feeding into the economy, and yet the market crashed another 50% after that. And they say don't fight the Fed. This is a perfect example of the moment where you should have been fighting the Fed. You should have been pessimistic on the market, despite the fact that the Federal Reserve was easing monetary policy significantly throughout that period. Now, August 2006 and December 2000, those are incredibly interesting moments to look at. August 2006 being right here and December 2000 being right here. So clearly December 2000, another very poor moment for investors to start expecting a strong economy. The S&P 500 remained very weak for months, if not years, after that signal. In 2006, you had quite an interesting rally right here, but a major recession quickly followed to bring down the market significantly lower than it was in August of 2006. What do both of these episodes have in common? You remember that chart of the yield curve that I showed you at the beginning of this video? Yield curve was inverting in December of 2000, and the yield curve was inverting in August of 2006. So these are prime examples where fund managers, investors, big money was getting excited about the economy, ignoring the signal that we had from the bond market here. Today, what do we have? We have a market that's rallying, risk-on behavior that's coming back into the market, and fund managers getting excited about a stronger economy in 2023 as we have the yield curve that's inverting very deeply here. By the way, don't forget to click on that like button down below if you're enjoying this video. It helps us out massively. So what's the conclusion from all of this? You're probably still looking for a clear-cut answer. Now, most people won't give that to you because that's dangerous and people can hold you accountable for the opinions that you give out regarding the market. Now, we love to give our opinion, but of course you have to be aware that's all it is when it comes to the financial markets, especially when it comes to betting which way the S&P 500 is going to go down. That's something that we love to do and that we think we're pretty good at. But when it comes to what it takes to actually outperform as an investor, you have to be looking for opportunities elsewhere. Some of the trades that we have in our model portfolio right now are up 20, 30, sometimes even 40% since their inclusion in the model portfolio, like German small caps and Bitcoin that we added to the portfolio very close to the bottom. You can go and see the details of that on our website. But getting back to what these signals actually mean for the market, the yield curve inverting to the deepest levels since 2008 and 2000 is at the same time a blessing and a curse. It means that if we add the Fed funds rate, you can see every time the yield curve inverts this deeply, we're very, very close to a Fed pivot. Very, very close to a Fed pivot. You can see here, August of 2006, Fed pivot. Even in 2019, you had a Fed pivot, which created the rally back here in 2019, and a Fed pivot is around the corner. We're practically there. It would be very surprising not to see the Fed really begin to shift their tone in the next few months. So all else being equal, if the Federal Reserve decides to pivot here, what's going to happen to the market? Well, it's going to rally. People are going to get excited. Risk is going to go through the roof. Fund managers are going to start expecting a very, very strong economy as they stop worrying about the tightening cycle. And so you could see a significant rally following a Fed pause. But the curse is that yield curve inversions systematically lead to a decline in earnings in the next couple of years. 2006 earnings decline, and we posted a lot of research on this on the website, going back to yield curve inversions, back to the 60s, 70s, throughout the recession in the 80s and 90s. You always see an earnings decline. It's not a question of whether or not it's going to happen in the next 1 to 2 years. It's a question of how quickly it's going to come. You can see here in 2000, it came almost immediately. Earnings started to decline very, very quickly after the yield curve inversion. In 2006, however, it took a little bit longer to happen. In 2019, it clearly did also take longer to happen. So I don't want to throw in the towel yet on this S&P 500 run. We've been optimistic on the market, expecting peak inflation that we saw back in June here to bring up the market. But the fact that the Fed has remained so tight and has not flipped throughout this period has kept the market trading pretty low and limited the positive impact that a disinflation environment can have on the market. So it has been quite a disappointing performance since that peak in inflation, but we may still be in that window of opportunity. Of course, as soon as we shift our take on the S&P 500, we'll be changing our positions in the model portfolio. We'll be cutting our exposure to US stocks, switching to a much more defensive posture as we begin to brace for impact on earnings later in 2023, and trades like Bitcoin and German small caps that have been performing incredibly well will be trimmed and possibly closed when we get there. So make sure to grab the free trial in the description down below. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed this video. If you did, again, don't forget to smash the like button. And if you haven't already, subscribe to the channel. Now, in the meantime, I wish you good luck on your trading and see you next time.